Hey guys, welcome back to Trade Options Like a Pro by Sensible. This is the fourth and final part of what affects option prices series. So far, we have looked at stock prices and strike prices, intrinsic value and time value, and option value with the passage of time. In this video, we'll look at the most important, I repeat, the most important and the least understood part of option trading, that is volatility. Let's put it this way. Volatility trading is the single most important part of options trading. It's so important that option traders often describe themselves as volatility traders. Understanding volatility is the single most important part of getting into options trading. So right after this webinar, we'll have another series of webinars which will purely deal with volatility and its effects on option prices. So let's start the most elementary part. But before we really jump into IV and understand how important IV is, we kind of need to understand if IV is really that big a deal. In the sense, if the impact of 1 or 2% change in IV is only going to be, let's say, 50 paisa or 1 rupee on an option of 100 rupees price, and what's the point of digging deep? Anyway, you're going to make money on the movement of the underlying, right? So let's just figure out what is the impact of 1% point change in IV before really putting in all the effort to learn about IV. So this happens to be the Sensible Option Trade Analyzer. This is going to be released to you very soon, and let me just plug in some values of at the money strike option so that I can figure out how much is the impact of IV. So let's just say that Nifty right now is at 10,440 or something, so ATM is 10,450. My target, let's say it remains the same, 10,450, and let's say the target date is day of tomorrow, and let's go with this, right? So the objective of this entire exercise is to find out the impact of IV on the price of an option. So here we are. Here you can see the call P&L and put P&L on this option, and yeah, these three sliders let you analyze the scenarios of different underlying levels and days and IV and all that. So what I'm essentially going to do here is this. Let me just reset this IV to 12 because it's a round number and it's nice that way. And at 12, the expected price of an at the money call and put is 98 rupees. So the question is, if IV was to change 1% point, let's say it just increases 1% point to 13, how much would the price of this option change? And you can see that it has jumped nearly 10 rupees. So that is actually 10% of your option price for a 97 rupee option. So then we also understand that the value of IV is not really trivial, especially when you're trading at the money or options which have some time left to expiry. Let's just do one more exercise to figure out how important IV really is. So I'm going to reset everything. IV is going to be set at 14. Underlying is at 10,450. So the question we want to answer here is, in terms of underlying movement, how significant is IV movement? So let's say, let me rephrase the question. When IV moves 1%, the kind of change it brings to the option price, how much does the underlying need to move to get the same change in option price? So let's put IV move of 2%, right? So let's say IV went to 16%. So the call options price would roughly go to 134. 130, right? So for 2% change in IV, the call options price jumped 15 rupees. So I'm going to reset it back, and now the question is, to get the same kind of change, how much does the underlying need to move for the call option to be priced at 130? The answer to that roughly is 30 points. So let's just do 30 points. Yep, it's 30 points. So a 2% change in IV is as big as a 30-point move in underlying itself. So then it's not really trivial to ignore IV because it's a significant factor in deciding option prices. So now that we are entirely convinced, let's just move on and learn IV, right? Okay. What is volatility? Volatility is a measure of fear or uncertainty in the market. So when the market is uncertain, or when there's a lot of market movement during an event, or even when the market moves a lot without an event, we say that the market is volatile and that the volatility is high. Let's start with the most elementary and the most important thing to remember. Higher the volatility or higher the uncertainty, higher is the option value, which is pretty obvious if you think that options are basically like insurance contracts and the sellers of options are taking risks on themselves. So the person selling insurance will charge you more if there's a higher risk for him or her. As usual, let's illustrate with a comic. So somewhere in the last week of October, you come to me and ask for an SBI call option in the afternoon. So you asked me for a 260 call. The way I looked at it, the stock was around 250 and there was very low chances of 260 happening. So I just sold it to you for a very cheap price, which is 2 rupees. And then you're telling me that, FM is announcing a package this evening. We all know what happened on the next day. SBI opened around 291 and closed it around 315. Everybody who sold a call option basically lost his shirt. So when the FM announced the PSU back package, something fundamentally changed in the market. There was a lot more uncertainty and therefore risk for the call seller. So the call seller needs to be compensated for the kind of risks he's taking in the face of uncertainty that day. Accordingly, he'll price the option higher. In fact, the price of the option which would have compensated the seller for that day was like 50 rupees, which is phenomenally high. So when there is going to be a huge movement in the market, the option seller must ask for more money to cover his losses. So he has to price the option higher. The problem is, how does he price higher? I mean, what changes in the black-scholes input to price it higher? That is IV, and how? We'll find that soon. So the option price increases or decreases when there is change in IV. What exactly do I mean by that? And what exactly happens behind the scenes? So assume that you're an option trader and somebody asks you for the price of an SBI call option. To price the option, you'll take a black-scholes calculator and you'll feed the inputs into that. So the inputs are stock price, strike price, time to expiry, and implied volatility. The option price comes out as an output. To understand this better, let's look at two different scenarios. So let's say we go back in time, SBI is at 250, expiry is 15 days away. How much will you charge me for a 260 call? In scenario 1, tomorrow is a normal day. In scenario 2, there is an announcement by Finance Minister after markets on bank recapitalization. In this case, you'll quote two different prices, right? Because scenario 2 is a way more dangerous scenario to sell options. But then almost everything is same in these two scenarios. SBI's price, the strike price, the days to expiry, almost everything. So where's the difference coming from? Let's visualize this. So that is you putting the ingredients of an option price into a black-scholes model. Its strike price, its SBI's stock price, days to expiry, they are exactly the same in two scenarios. The only thing which can be different is the IV. So after it is known that there is going to be an announcement, there's great uncertainty in the market and you're taking higher risk in selling options. So you will charge a different price which is higher, and this price is achieved through a higher IV. So I'm going to repeat this. The value of the IV you enter into a black-scholes on a normal day is going to be significantly different from the value of IV you enter into black-scholes calculator before an important announcement. IV is what changes option prices when everything else remains the same. So now let's move on and find out what exactly do we mean by IV or implied volatility. Implied volatility is the volatility implied in the price of an option, as the name suggests. In other words, it's the value of the volatility that was used to arrive at the price of an option using a black-scholes model. To get IV, you start with the premium or the price of an option from the market, and then you back calculate the value of IV which was used to arrive at the option price. So now let's put it all together. Implied volatility is a measure of how much movement the market expects. It is the single most important number in option trading. When the market expects huge moves, option sellers charge higher, options become expensive, and this happens because of increase in IV. And how do we see IV? Well, you can either go to NSE options chain or you can use the sensible calculator and find out IV. Actually, you know what? Just use the sensible calculator. It's way simpler to do it with that. So as we already discussed, IV is a measure of uncertainty or a fear. Very specifically, it's a fear of sudden down moves or fear of big moves, which is either up or down. IV usually increases when market goes down, especially in gaps, and it usually decreases when market is still, slows down, moves a little up or moves slowly. IV is very high near the events like elections, FOMC, RBI policy, etc. And for single stocks, IV spikes up just before their results or any stock specific event. Largely, IV goes up before an event which increases the option prices, and it goes down after an event which decreases option prices. This is something we have to be very careful about. It often happens with us that a lot of clients buy a lot of options. Let's say they buy call options, the market goes up, but even then the option price does not increase. This happens because when you buy an option before an event, you normally buy it at a high IV, and after the event, IV suddenly drops, which takes a hit on your call option or put option price. So, at what IV you entered in options becomes very important in getting a hang of how your P&L is going to look like. Now we come to the most important question: how do you make money trading vols? So by now we know that option trading is basically volatility trading, which is if you're delta neutral, but we'll come to that later. So ideally you should buy options with low vols and sell them at high vols. But then the question remains, what exactly is low vol and what is high or expensive vol? Unfortunately, there's no absolute measure to this. The only meaningful way to decide whether IV is cheap or pricey is by taking into consideration historical IVs and market moves. We'll cover in detail how to look for cheap volatilities in another webinar, but then till then we would ask you, please don't jump into IV trading, especially on the buy side. For now, let's just put it this way: let's stop buying IVs near events if vols are high, and let's stop selling IVs near events if vols are low. So that brings us to the end of this webinar. I'll see you soon in the next webinar, where we'll dive deeper into how exactly IV behaves and what are the nuances you have to be careful of while option trading. Till then, take care and bye.